Hi, my name is Mike, and I'm the Chief Investment Officer here at Lighthouse Financial. And I am here to provide you another monthly market update. So let's jump right in. Okay, October 2023 is where we are. Here are our talking points for this afternoon. This has been a miracle year, really, for investors. Just when things were supposed to really fall apart in 2023, we see a surprising resurgence of economic growth, business investment, and consumer activity, and this was just not supposed to happen. And but I still see a pretty broad mismatch between sentiment, how we feel, and the data. So we all feel like this really isn't much of a miracle, and this is a pretty tough environment, whether you're a consumer or you're an investor. And that really is not what the data is showing us. So I'll walk you through that. We do see some new risks on the horizon. Inflation is sort of proving to be a little bit sticky. In other words, it's come down a lot, but I think bringing it down from here is going to be a little more difficult. And because of that, the Fed's going to keep rates elevated up here for a while. Investors, and this is a new thing, investors are starting to push longer term bond yields higher. So longer term bonds are selling off, and that's allowing interest rates to sort of move higher. And I'll explain that in a moment. And then finally, of course, geopolitics. And the story of the day back in 2022 was Ukraine and Russia. And then after that, everybody wondered if China was going to invade Taiwan. And now we have another conflict in the Middle East between Hamas, really, and Israel. So we'll discuss that a little bit. These are the new risks on the horizon. And finally, I want to put this debate to bed about whether or not the U.S. consumer is healthy or on the ropes. So we'll talk a little bit about jobs, the savings cushion from all of that stimulus provided during COVID, wages, and then spending, consumer spending. And then at the end here, we'll reassess the economy's landing. In other words, are we going to be successful in landing the economy, bringing back equilibrium and bringing down inflation without choking off growth and driving us into recession? That's the big question. Okay, surprise, surprise. This is the Citigroup Economic Surprise Index, and this is just one chart that measures how well the data is coming in compared to expectations. So economists have been sort of Eeyore-ish or pessimistic this year, and it looks like the data is coming in significantly better than expected. I've drawn this line, the arrow upward. The chart really sort of troughed recently in the middle of 2022, right before the stock market bottomed, and since then has sort of been winding its way unevenly higher. That's good news for the economy. It just means that we most of us have been behind in guessing how strong the economy could be under these kind of trying conditions. And here's another chart just showing that growth did reaccelerate. You see that black line, the beginning of 2023 started to move higher. That's what they call gross domestic product. Essentially, that's just U.S. economic growth, and this is a year-over-year change. So the economy is growing 2.5% over what it was a year ago. It's looking like to us the third quarter is about the same or even stronger. So this wasn't supposed to happen. We were supposed to have a recession, as you remember, and that was ordered up in the spring of 2022, and we just keep waiting for it. A lot of Wall Street wants to convince you that it's right around the corner. It's tomorrow, it's next month, it's next quarter, it's at the beginning of 2024. They've been saying that now for about a year and a half. And one reason that we haven't had a recession is that stock market expectations are rising again. As an investor, what the most important thing to you is whether the companies that you're investing in are making money. Are they making money? Yes or no? And then are they growing their sales and growing their profits over time? This chart just shows the estimate consensus estimate from all the analysts on Wall Street, how they feel about corporate profits going forward 12 months. And as you know, the stock market is anticipatory. Today's trading in the stock market, or this month's trading, should be based on how people feel about the next 6 months. That's about how it works out. The stock market anticipates about 6 months into the future. This chart shows 12 months of expected profits, and you can see that since early 2023, it's really off to the races. So the negativity is sort of wearing thin, and it turns out that most US companies are doing a pretty good job of dealing with all the curveballs they've been thrown since COVID and figuring out how to make money. No surprise there from my seat. That's pretty typical. All I wanted to show you here was, though, that there's been a broad inflection point in terms of how investors feel. More on great expectations here. This is from Zacks Investment Research, and Zacks is just polling investment strategists and investors as well. And they're saying, okay, let's take a look by quarter at profit growth and sales growth for US companies that make up the S&P 500. What I want to show you here is in the box in the middle. Third quarter 2023 is supposed to be the last quarter of negative earnings growth or negative profit growth. This will be the fourth consecutive quarter of negative profit growth, and that is generally called an earnings recession. So maybe the entire economy hasn't gone through a synchronized recession, but certain parts of it have, and this just shows you that we have had an earnings recession and we're about to come out of it. Again, inflection point. So it should come as no surprise to you that the stock market bottomed a year ago, almost exactly to the week, bottomed in October 2022 and has sort of moved unevenly higher since then. And I know the last couple of months have been tough, usually a seasonally weak period in August and September. And incidentally, if you look at stock trading almanacs, the middle of October is usually an inflection point where seasonally things get a little better. Well, right on schedule, about a week ago, the market started to trade up a little bit. Not all stocks are created equal, and I've talked about this in previous market updates. Tech sector tends to be doing better this year than, say, some value sectors, especially like financials. And these charts that show the Dow and the S&P 500, the Dow, because it doesn't have a lot of those tech or high flyer stocks, has not done as well as the S&P 500 this year. But my point here is to show you that, broadly speaking, I believe the worst is behind us. All right, we got to talk about inflation because that is the boogeyman, right? That the reason that the Federal Reserve had to raise interest rates so high to a level that they call restrictive, in other words, it is intended to restrict economic growth, is because they need to fight inflation. So we've made a lot of progress, and you can see here this black line is the consumer price index. This is a measure of retail price inflation, and it peaked out in the middle of 2022 and it's been heading lower. The blue line is what they call core CPI, which just eliminates food and energy. Those two categories tend to be very, very volatile, and the Fed wants to get at really what is the underlying level of inflation in the economy. So that's why they also look at the core. And I want to just show you that, this black line ticked up for the last couple of months. We were making great progress, and then broadly speaking, inflation started to reaccelerate a little bit. Now, am I sounding the alarm bells? No, but you can see at the lower part of that chart where I put a red arrow at 2%, which shows the Federal Reserve's target for inflation. We're still a ways away. And because we're still a ways away from that target, it seems like the Fed is probably going to keep rates elevated for a while. So have they done enough? Like, have they raised interest rates enough so that they can sit back and sort of monitor the economy and monitor inflation? I think so. It seems that that's the case. This chart shows you going back a while different interest rate cycles going all the way back to 1988. And it shows you how much and how fast the Federal Reserve took interest rates up when they felt like they needed to cool off inflation. And the black line is where we are in this interest rate cycle. It shows that the Fed has raised interest rates more and faster than any of these prior dates back in time. So have they done enough? Yes. I mean, what they're doing here is not unprecedented, but it is still a pretty much a shock to the system. When you take mortgage rates up from 3 to 7% plus in the span of a year and a half, that's pretty serious, and you run the risk of delivering a shock to the system that drives us into recession. And I know that there are other lending rates that are even probably more important right now. Auto lending rates are up about 2 full percentage points since the Fed started raising interest rates. Small business loans are up by a factor of about 2. They're twice as much as they were pre-COVID. So has the Fed done enough? I think so. So we don't expect any more Fed interest rate hikes. We do, however, expect rates to stay kind of at this elevated level for a while. Again, that restrictive level where you're putting your thumb down on economic growth potential. All right, let's talk about the new things that are showing up in the market right now that we're monitoring. This is the primary thing I'm monitoring. This chart is a little bit busy. I'll walk you through it. It just shows what interest rates you can expect if you buy Treasury bonds at various maturity levels. And so at the very left-hand side of that chart, those are really short-term bonds, like 3-month, 6-month Treasury bills. And you see that's where you get the highest rates. I mean, those rates are well over 5.4%. So that's not normal. Usually it's longer term loans, 10, 20-year loans that have higher interest rates, but that's where we are in this sort of weird economy and after COVID. So we're trying to right the ship. Long-term bond yields are rising, and the 10-year Treasury rate has gone from about 4.2 up to 4.6 in the last month, roughly. And that is a little bit alarming because there could be some good reasons for that or some bad reasons for that, and that's why we are paying attention. I mentioned that we're all trying to normalize, right? The financial system is trying to find equilibrium, and it's not normal for really short-term rates to be higher than long-term. So that needs to get unwound, and that's kind of one of the good reasons that rates might be moving. The Fed controls really short-term rates. The Federal Reserve does not control long rates very well. And this activity that I'm showing you right here, this rise in long-term rates, really has to do with investors. They are selling off long-term bonds. All right, so, why? First of all, I really do think we're returning to normal. This chart goes back a long ways, multiple decades, and you can see that the interest rate you would receive for buying a 10-year Treasury note used to be a lot higher than it is now. The chart goes all the way back to like when I was in high school, and you can see that a rate of 8% was not abnormal, or 9% back then, but rates have been falling for multiple decades, and the aftermath of COVID really has seen that trend, that long-term trend, turn around. So, is it a shock to see mortgage rates go from 3% to 7+ in a year and a half? Yes. Is 7.5% roughly more normal? Was that a more normal mortgage rate? Absolutely, more normal. So part of this is we're returning to normal. But there's other reasons why this might be happening, and I want to walk you through them. Lower chance of recession, maybe. Look, if recession was really around the corner, I think you'd see investors buying up long-term treasuries because they're seen as sort of a safe haven. And we're just not seeing that. We're seeing them sell off. So I think rather what this is saying is investors are building in a chance for higher inflation expectations well into the future. In other words, maybe the Fed doesn't bring long-term inflation down to 2%. Maybe they can bring it down to 3%, which if you look back long term in the US, that was the textbook average annual rate of inflation. So maybe that's what it's saying. Also, the Fed has this program that we call quantitative tightening, which is a silly term and it doesn't describe very well what it is. It's essentially, it's just the Fed undoing some of the stimulus that it did before. There was this money machine where the Treasury, US Treasury, would issue debt and the Fed would buy it up. And the idea was that we could keep interest rates low and stimulate economic growth in tough times. So that's what they were doing beforehand, coming out of the housing crisis. It was called quantitative easing. Anyway, we're on the reverse side of that. The Fed's trying to unload some of these bonds that it has on its balance sheet, and that just adds to the selling pressure on long-term bonds, and it could be pushing yields up. And finally, maybe investors are starting to get worried about government deficits. And I put a chart here on the right-hand side of this slide, and it shows you the difference between government spending and tax revenue collection going back to 2000. I believe 1999 was the last time we had a balanced federal budget, or excuse me, a surplus. Since then, things have been steadily deteriorating in terms of keeping our spending within our means. And you can see that COVID really ballooned out federal spending deficits. So this could be an issue, because if the perception sort of exists among the investment community that the US is going to have a hard time paying its bills into the long-term future, well then of course they're going to demand higher interest rates to buy US debt or Treasury debt. So this could be one of the signals of these longer term rates moving upward, and we're watching that. I feel like I need to address this running debate in the investment world regarding the health of the US consumer, because this is key to the strength of our economy. 70% of our economy really is just made up of you and I going and buying things, whether it's gasoline or vacations, whatever. 70% of the economy. One of the big reasons that the consumer has been okay through thick and thin over the last couple of years has been that layoffs never really materialized. Yeah, a little bit. There was a little spike in layoffs in early 2023. Even that's unwound, and it seems like some of the people who were laid off from like big tech have found jobs since then. Look, if everyone has a job who wants one, it's really hard to say recession's around the corner. You really have to. You're running a risk predicting the future doing that. Jobs are plentiful too. I mean, it's not just that there haven't been layoffs. This is a U.S. job openings by industry total chart, or what they call the JOLTS report, and it just shows the number of open positions at over 9 million. And so what that means is there's about 1.5 open job positions for every unemployed person. I wanted to show you this chart just because that number is well over what's considered normal, which is probably around 5-6 million. Wages and inflation. Much was made of the fact that inflation since early 2021 has really been outpacing wage growth. So in other words, if your spending on everyday items is going up by 9% a year or 10% a year, but your wages are only going up 3 or 5% a year, then you're falling behind financially, and consumers can only keep that up for so long. What we've seen though in the last several months is that inflation has fallen below the rate of wage growth. And while wage growth is moderating, it's coming down, it's still not really back to normal, which would be sort of more like 3%. And so that's good for the consumer, right? Because prices aren't increasing now as much as your pay is increasing. On the other hand, the Federal Reserve really wants to get wage growth down to a more normal level. They really want to see that down toward 3%, I think, or even lower. So what are they willing to do to get it there? And the Fed should step back a second and just say that the Federal Reserve tells us that their intent is not to drive the economy into recession. They're trying to avoid that, but they're always quick to say that that's not their primary goal. The primary goal is to fight inflation, and that's been a high-profile bogey, but a tough one because it's really hard to predict the pace at which prices are going to come down. So let's take a look at consumer spending too. I know a lot has been made too of this idea that consumers have spent down their COVID era stimulus payments. It is true, and the bank CEOs tell us that most Americans have a higher balance in their checking and savings accounts than pre-COVID. And when I say higher, I mean a lot higher, like multiples higher. And so we heard today from Bank of America's CEO, Brian Moynihan. He said that that's true, that we're starting to see some of that cushion, that savings cushion, be slowly spent down, is how he put it. Okay, so the media took that and ran with it and said, oh my gosh, consumers are running out of money. I listened to the interview, and that's not what he said at all. He said slowly. So consumers are slowly spending down that cash buffer. And he said for that to run out, that extra cash from COVID, he said it would take many months at this rate. So let's put things in perspective and not jump to conclusions. I want to show you this chart here, which is total credit card spending. And I think it also includes debit. And they break it down between total spending and then services and retail, which is sort of like goods. So goods and services, you can see a big come down from 2021. In 2021, we were all revenge spending. We were coming out of COVID and spending a whole lot more than we had because we were deprived of vacations and furniture and a whole lot of other things. Well, that's abnormal. You can't keep up that high rate of spending. Nobody can, unless they're Jeff Bezos or somebody. But the point is that we're moderating. Spending is moderating. We're normalizing, and total card spending only dipped negative for a little bit, and it started to rebound. If you listen to Brian Moynihan today, he said that in 2022, overall, they estimate that overall consumer spending was up by about 9% during 2022. Unrealistic, right? You can't sustain that. He said this year, up until mid-year, he said it was probably tracking to about that 9% again. But since then, spending has slowed, and now we're looking at something more like 4 to 5% year over year for 2023. Is that healthy? Yes. He said that really sort of corresponds with a normal economy. It corresponds with the level of spending growth that we saw before COVID. So in my mind, that just means normalization. It doesn't mean we're falling off a cliff. Just a couple of quotes here. JP Morgan CEO Jamie Dimon he noted some of the same trends as Bank of America did. He said U.S. consumers and businesses generally remain healthy, although consumers are spending down their excess cash buffers. Overall, the banks tell us that most Americans are in a better shape now financially than they were before COVID. Now, that's not all strata of society. Certainly, lower income households were hit disproportionately hard by high inflation because a greater percentage of their earnings goes toward necessities. And so it's not discretionary. So they got hit much harder. Going forward, though, I think some of that pressure will start to come off because we're told that wage growth at the low end is the highest of all the strata. So low-end jobs are having to raise wages at a higher rate than any other strata. Let's take a look at credit card usage just in a little bit more detail, because one of the things that we're hearing from Wall Street analysts and from CEOs is in the financial services arena is that average credit card balances per person in the US are now at a record. And that's the orange line of my Halloween chart here. Average credit card balances are closing in at about $3,600. That is the highest ever. But I think one of the reasons is that we've had to deal with higher inflation. So everything costs more than it used to, and that means higher credit card balances. Let's take a look, though, at credit card delinquency rates. This is what we really care about when we're trying to catch the early onset of a recession. And so this is early delinquency, only 30 days, right? You can get this chart in different flavors, 30 days, 60 days, 90 days plus. So this is 30 days and up. And you can see that the rate of delinquency is about 1.2%. We are not yet where we were pre-COVID. And Bank of America CEO Brian Moynihan made a great point today. He said, yes, we are seeing delinquency rates rise. He said, but they're still lower than they were in 2019, pre-COVID. And by the way, 2019, if we just move back there for a moment, that was the lowest delinquency rate in 40 years for Bank of America. So he was saying that, look, we probably need to, we're moderating a little bit higher. So we're normalizing, delinquency rates are rising, but this is not the time to blow this out of proportion or be alarmed because we're still at very, very low levels. And he said the same thing about corporate delinquencies, that they are still very manageable, even though they're rising a little bit. So this brings us to the question, where is this recession that we just keep hearing about, and it won't show up? Forecasters see stronger U.S. economy in the near term. This is from a Bloomberg survey of investors, and it shows expected economic growth. And between the September survey and the August survey, and so these are rates of growth, and you can see that during Q3 2023, which is the quarter we just exited, these investors were expecting in August to have about 1.8% economic growth. But by the time the September survey came around, they had to up their game, and they're saying now it's going to be more like 3%. And that's kind of what has happened this year. Everyone's estimates of future growth have had to float higher to match reality. I want you to see, though, look going forward into Q4 2023 and then Q1 2024. Economists are still expecting a slowdown here for a couple of quarters. And that you see that in the August survey and the September surveys. Will that be right? I don't know. It's right now, that's difficult to see. I think there's this expectation that the economy is going to have to slow because the Fed won't lower interest rates and it's tough to borrow. And you are seeing loan growth slow because rates are significantly higher. And if the Fed continues to keep interest rates at this level, or even raises rates more, then that will be more restrictive on growth. So perhaps this sort of that hollow spot in this chart right here, maybe that's just sort of this expectation that, okay, lower growth has to come home to roost at some point. But I'm telling you, all the data that we look at right now do not point to that slowdown. And even if it happens, those expected growth rates are not negative like we experienced in the first half of 2022. So I think all that said, recession is a pretty low probability in the near term. So it's all about the landing again. You see this chart from me time and time again. And I put this quote at the bottom from the Citigroup CFO. He said, the US keeps surprising us with its resilience. So I think it's hard to call. I do think we're likely to land in a softer way than we thought. He's walking back his prior expectation for recession. And that's kind of the theme of the last few months. All kinds of CEOs and economists and Wall Street professionals have had to walk back some of their recession calls. And It's just that the data has not been tracking nearly as negative as they thought it might. So you can see that I've crossed out the two sort of extreme scenarios going forward, the no landing and the hard landing. The no landing just means that the Fed can raise interest rates all they want. The economy is so strong that it's not going to slow down. And there are some signs that that's a possibility, but I think some of the moderation we've seen, so consumer spending is moderating, business spending is moderating. I think that means this no landing scenario is not a probability at all. I crossed out hard landing just because that's the kind of a severe recession scenario that I think is not going to happen either. That's not a likelihood at all. So we're left with soft landing and bumpy landing. And a year ago, I told you that I thought we would have a bumpy landing. And that's kind of how it's playing out. In other words, a lot of market volatility in both bonds and stocks and commodities as well. Frankly, I mean, there's been nowhere to hide from this kind of volatility unless you're just locking in your rates in buying treasury bills. And we've been doing some of that for the last year for our clients as well. But I think we're sticking with a bumpy landing scenario. Soft landing would mean there's really not much volatility to be had. And we know that historically, those occasions are pretty rare. I think consensus says that we probably had a soft landing in 1994 during that rate hike cycle, that inflation scare. This is a little more severe than that. And so I would expect that you'd see some volatility going forward. But critically, it's just hard. It's hard to predict that we would go down and even test the stock market lows of October 2022 unless something breaks, something pretty serious in the financial system. I mean, we've already weathered the Ukraine-Russia war. We've weathered threats of government shutdown, and we've weathered the banking crisis in March. And all of those things have sort of passed without causing severe damage to the global financial system, and certainly not to ours. So with that, I think it's hard to predict recession. I'm sticking with the bumpy landing, and I think the smart thing to do is to remain invested in a responsible way going forward. We'll be back again, of course, next month with any updates. But in the meantime, I want to thank you for watching, and have a good day.